Welcome to today's Wealth Channel webinar. I'm Jimmy Atkinson, co-founder of Wealth Channel. At Wealth Channel, we help high net worth investors grow their wealth with alternative investment strategies. And today's webinar is commercial real estate investing for passive income. Today's webinar is sponsored by First National Realty Partners. And our presenters today, we're really excited to have them, are Michael Hazinski, Chief Investment Officer at FNRP, and Fred Battisti Jr., Chief Revenue Officer at FNRP. Michael and Fred, welcome. We're going to get to you and your presentation momentarily. But first, I just want to let everyone in the audience know that, yes, today's webinar is being recorded, and we're going to circulate a recording of this webinar to everyone by tomorrow. Secondly, we want this program to be interactive. And here's where we're counting on our live audience. That's you out there attending live. If you have questions for Mike or Fred about anything that they're discussing today, please use the Q&A tool in your Zoom toolbar. Don't be shy. We want a lot of questions, and we're going to save some time toward the end of the hour for some live Q&A with our two speakers today. And with that said, Mike, Fred, welcome. Thank you so much for joining us today. How are you both doing?
Thank you, Jimmy. Thank you for having us. Really appreciate the opportunity. Doing great. Excited about being here.
Yeah, thanks, Jimmy. Great to be here, and look forward to this next hour.
Perfect. Yeah, should be a fun one. I'm looking forward to this topic. I don't know if anyone out there doesn't like passive income, so I think that's going to form a bulk of what we're discussing today. Should be an interesting topic. Gentlemen, before we tee up your formal presentation, you have a deck that you're going to walk through regarding your company and an investment opportunity through your company. I had a couple questions that I wanted to ask you about FNRP and your investment strategy. Firstly, there's been a lot of growth and news at your firm over the last year. So, before we officially get going here, can you give us an update on what FNRP has been up to lately?
Yeah, absolutely. Great question. Thank you, Jimmy. 2022 was really a transformational year for the firm. During 2022, we acquired over $830 million worth of grocery-anchored, necessity-based assets. What we ended up doing was doubling the size of assets that we have under AUM, so a really, really big accomplishment for the firm. We also signed a record number of new lease deals, over 105 new leases, 500,000 square feet last year. So that was a record year from us, from a leasing velocity and acquisitions velocity, really focused on that grocery anchor, retail, necessity-based sector. Furthermore, we recently announced that we brought in a new CEO. His name's Josh Champion. He is here in Atlanta, where I reside as well. Josh was previously the president and chief investment officer at Carroll Organization here in Atlanta. They're a multifamily firm where Josh, during his tenure as president and CIO of the firm, Josh acquired over $12 billion worth of multifamily assets, 75,000 apartment units, which is a great accomplishment. But if you ask Josh what he's most proud of, his returns to his investors were, on average, they were a 29% IRR to his investors and a 2.2 multiple on the equity of the investment. So we're really excited to bring Josh on board because we already have the retail grocery platform really, really baked here at First National. We're really excited to get into this next phase.
Necessity-based commercial real estate has certainly come up quite frequently in our recent discussions. Historically, FNRP's niche has been in grocery-anchored retail. Can you walk us through what led to that shift? Why are you focusing more on necessity-based commercial real estate?
Sure. I think the necessity-based thesis is really what drives grocery anchored, and the necessity-based thesis has been in the works for years at this point. And we've been focused, as Fred said, on building a track record in grocery anchored retail, and we've certainly done that. We've been the most active acquirer of open air retail last year. We've realized some phenomenal returns for our investors that we'll get through in our deck as well. So really, that necessity-based investing is really the same model and same investment thesis that we're going to apply to other asset types. We recently launched our first multifamily deal, and it can be simply put as food and shelter is the necessity-based thesis. So Literally the last two consumer staples that are negatively impacted in both good and especially bad times are food and shelter. So food being distribution through grocery anchored retail and regional and light distribution on the logistics side, and shelter to us is middle market workforce housing. So very bullish on those subsectors specifically, and just excited about the growth of the company.
And there's a huge shortage of that type of housing all over the country. And I suspect in a lot of the areas where you're investing, I'm sure we'll get into that more with your presentation today. With that, Mike and Fred, thanks again for joining today. I'll let you take it away with your presentation if you want to go ahead and get your screen share going. And again, just for those who may have just joined us in the last few minutes, or in case you missed my earlier announcements, we do want this webinar today to be interactive. So we're going to save some time at the end of the webinar for some live Q&A. If you have any questions for Mike and Fred, please do use the Q&A tool in your Zoom toolbar. And with that, gentlemen, please proceed.
Great, thank you very much. So I will start off here. Fred is going to drive the deck, so thank you, Fred. Commercial real estate investing for passive income. If we could keep scrolling through. This is the typical investment disclaimer, which we encourage everyone to read. Won't spend a lot of time on it here. If we click through to the next slide, please. So here's where we're going to go today. First, I'll start off with a firm overview of FNRP. I will then talk about our necessity-based thesis a little further in item number 2 here. Then I will kick it back over to Fred, who will go through a case study of grocery anchored retail. And then I will wrap up with our current multifamily offering that I alluded to previously. So we will have time for some Q&A, as Jimmy said, and please feel free to interrupt us as we go with any questions. We certainly would like to be as interactive as possible. So with that, I will get into the firm overview of FNRP. So the company was founded in 2015. As Fred mentioned, we doubled our AUM last year to more than 1.5 billion in assets under management. One of the leading private equity sponsors of commercial real estate, most active acquirer of grocery anchored retail, where we've really built our track record that we're extremely proud of, and launching into other asset types under the necessity-based thesis. If we go to the next slide. So this is our leadership team. That includes Fred and myself, over 130 real estate professionals in the company. We mentioned Josh Champion, our newly appointed CEO. Really take a hands-on approach to the investment as a vertically integrated company, which we'll highlight on the next page here. So vertical integration in FNRP, we deem this FNRP 360. And really, it's a cradle to grave approach with an ownership mentality. So everything from sourcing the acquisition to underwriting, debt capital markets, legal, closing, asset management, leasing, property management, construction is all done in-house, all done around this wheel. It's very much an ownership mentality in every aspect of this. And it's something that we really pride ourselves on and we think generates outsized return for our investors. Certainly one of our secret sauces at the company. Our investment approach here, which we'll talk about throughout the slide deck, starting with our dragnet acquisitions model. And I think one of the biggest benefits from my seat is on the acquisition side is the phenomenal growth we've had. We're able to source an enormous amount of acquisition opportunities. We are top of mind, certainly in grocery anchored retail and with the newly launched multifamily platform as well, with all the relationships we have in house. We're able to source an enormous amount of opportunities. So really leveraging a national platform, utilizing local knowledge, retailer relationships on Fred's side to really pick the best opportunities. And that's what we call the dragnet acquisitions model. Necessity-based investing, we'll get to here in the later slides, alluded to it on the earlier call. And the FNRP 360, again, the hands-on vertical integration of the company. We think these 3 pillars are really what support our success in FNRP. All right, FNRP by the numbers. So there's a lot we're proud of at the company, and I think one of, if not the most biggest sources of pride, I should say, would be this 19.4% gross IRR on 11 total realized investments in 2022. So company was founded in 2015. We were able to realize 11 investments total, generating a 19.4% gross return. And something that we're thrilled with as we built our track record in the grocery anchored space that allowed us to expand into other asset classes. I mentioned the 1.4 billion in AUM, over 90 million in investor distribution since inception, 2,300 investors comprising over $600 million in equity in the company, and we're in 22 states across 11.5 million square feet. All right, necessity-based CRE investing for passive income. So if we get right to it, we're going to set the table here on the asset classes. And really, you could see here, this is the NCREIF property index, really the benchmark for direct real estate. I think if you see here, if you're able to look at the since inception returns of this top box here, since inception standard deviation, if you did a quick Sharpe ratio, you would see that apartments are the best performer, followed closely by industrial and retail. Fortunately, we don't have to talk much about office throughout this webinar, but those have been the three primary performers from a very broad-based sector. So apartments, there's garden-style apartments, which we'll focus on. There's high-rise, low-rise, more infill, a lot of subsectors in apartments, obviously industrial and retail as well. So we'll kind of dive into those a little bit. But just wanted to point that out here that apartments, retail, industrial have been the strongest performers over a 45-year track record, call it, in the direct real estate space. Certainly industrials benefited. You see the one-year returns, the cap rate compression there has really driven appreciation as of late, but really just steady performers across those three sectors. All right, necessity-based investing. So, from a retail standpoint, broad-based retail encompasses malls, lifestyle centers, community, power. What we really focus on is the grocery anchored space. So really daily needs, grocery anchored shopping centers, frequent customer trips, well located within communities and strong retail nodes, really serving as last mile retail. We think this sector of retail specifically will continue to outperform the broader group at the expense of malls and lifestyle centers and power centers. So that's where we really focus within that retail segment. Multifamily. From a multifamily standpoint, obviously several formats I spoke about earlier. In this economic environment, the segment of multifamily that we really like in particular, workforce housing, middle market housing, extremely durable. It doesn't have the peaks and valleys of some of the other asset types. And if you just take a step back and think about the headwinds today facing home ownership, from home prices moving so far so quickly, along with interest rates and what inflation is doing to the cost of living, these are really tailwinds to this segment of the multifamily space that we're going to continue to focus on. Lastly, industrial. As we get more into industrial in the future, we'll focus on this regional and light industrial centers, often distribution centers, larger buildings, typically more divisible, strong access to rails, ports, highways, labor. That's where you'll see FNRP continue to grow as well. So really, again, food and shelter, food with grocery anchored retail and industrial being that last mile distribution hub, and shelter through workforce and middle market housing. That's what necessity-based is to FNRP, and that is really the thesis. Moving along, you see real estate assets in inflationary cycles. We thought this was a good data point to show the group. Certainly all agree in the environment we're in today, and I think one of the myths is about real estate performance and inflation, and I think you see here on the left and right side of this slide, you see real estate outperforms both on an absolute basis as well as a relative basis. On the left-hand side, high growth, high inflation. I think this is the Fed's best case outlook for the economy today. Real estate outperforms both U.S. and global compared to publicly traded equities and bonds. And in the worst case, the right side of the page, call it stagflation, U.S. real estate is still the clear winner here. So I think this is top of mind for everybody and something, a continued tailwind for direct real estate.
Hey, Mike, just wanted to interrupt you here for a minute. We had a couple questions come in already. Thought it might be fun to kind of mix things up a little bit and see if we can get some answers here for a couple of questions from our live audience. David asks if you allow for 1031 exchange investment, and if yes, what is your minimum and maximum? Do you do any 1031s with your investors?
Yeah, I can take that. Yes, we do. We do take 1031s. Minimum investment is $500,000 on a 1031 exchange.
Got it. And then thanks for answering that one, Fred. And then Terry asks, on your previous slide, you were talking about some of the different sectors or asset classes within real estate that you are investing in. Are you doing any manufactured housing investment?
We are not at this time anyway.
Very good. Well, those answer those two questions for now. Keep the questions coming, everybody. I'll try to interject those throughout the webinar. We'll definitely save some time at the end of the webinar to get to the bulk of the questions, but keep them coming in, and we'll get to them toward the end of the presentation. And with that, I'll let you gentlemen get back to it. Thank you.
Great. That's a perfect breaking point. I was going to hand it over to Fred to drive this portion of the presentation.
All right. Hey, everybody. I just want to walk you through a few things on our geographic footprint and a few case studies as to what we do in grocery anchored retail and why we've been so heavy in it. And now Mike's going to talk about a little later, shifting into the multifamily world. But you'll see in 2022, we've got over 1.5 billion in assets under management, 55 properties, over 20 states, 11.5 million square feet. And you'll see some recent acquisitions here listed that we acquired in 2022. We are coast to coast. We do everything in-house, completely vertical at our firm. So you'll see something in the Bay Area as well as something in West Hartford, Connecticut, Bishop's Corner. So really proud of our national footprint. Recent acquisitions, these were the deals that we acquired in 2022, over $830 million. We're the largest and most active acquirer of grocery anchored retail in the country last year that did these individual assets one off at a time. Very proud of that number, and we are very, very active in the market. Again, Mike alluded to this earlier, but something we're very proud of here at FNRP in 2022, we sold 11 assets and generated an average gross IRR to our investors of 19.4%. So we're very proud of that accomplishment, and that goes into our FNRP 360 platform. And I'll touch a little bit on how we have a tenant-centric approach with our retailers here in a few minutes. So diving into a grocery anchored retail case study. So why grocery anchored? When we're looking at a grocery anchored deal, we're looking at market dominant institutional quality assets that are necessity based. So you're going to see Walmart, you're going to see Kroger, you're going to see Albertsons throughout our portfolio, as well as Home Depot, Lowe's, Ace Hardware, really those necessity needs for everyday consumers that you can visit our sites multiple times a week. And you're going to see top national brands with great credit throughout our portfolio. That's really what we focus on when we're looking at our investment and the dragnet acquisitions approach that Mike alluded to a little earlier. These are some of our key tenants. You'll see Albertsons and Kroger, Safeway, Walmart, Publix, Whole Foods, Aldi, Harris Teeter. Kroger's our largest retailer we have in terms of store count throughout our portfolio. Walmart's our largest in terms of GLA. We have a few Publix deals. We have a handful of Whole Foods deals and Aldi as well. So why are we focusing on these grocers and these necessity-based retailers? It's really reducing your credit risk and mitigating the risk in the investment. They're great companies. They're solvent companies that have reduced volatility within their leases. The leases are long-term leases, typically 10 to 15 years. They also have options and control beyond that, which really makes it a sound investment and a safer investment. And we really focus on tenant merchandising. I grew up in the mall world. I used to work at an institutional REIT, a public REIT, and a lot of the merchandising was a little different than what we're in now. And really what we're focusing on is merchants that are necessity based, the nail salons, the hair salons. You can't get those service uses in your house, right? For the most part. So that's what we're really focusing on. To Mike, what he alluded to as well, food and shelter. We measure everything we do in terms of all of our leasing and measure all of our metrics here at FNRP. You can't improve if you're not measuring it and trying to raise the bar year after year. Last year, a few of our KPIs on a renewal retention base, we renewed and retained 85% of the tenants that were rolling in 2022 throughout our portfolio. And we renewed those tenants at a spread of 7.69%. So Mike talked about hedging against inflation. There's your ultimate hedge against inflation. As the spreads in these renewals are getting better and better, thus far this quarter, we're actually at 13% in through Q1 and into Q2 of this year. Also, new lease averages, so variance versus prior, those tenants that we elect to remove from the shopping center for various reasons, whether it be credit, whether it be they're paying an under market rent, we're exceeding that rent at a clip of about almost 25%, which is a really, really great number. And then variance versus budget, you also see over 17.5%. So we're really able to drive the rents and drive the renewals throughout the current market, because there's really not that much new construction going on where these tenants have the ability to relocate it and move because construction costs have become so high. So it really puts us in a good position to hedge against inflation and drive those rates. A few case studies, and this really focuses on our tenant-centric approach. So these are the things that we look at soup to nuts at every acquisition. During due diligence, me and my team will go out, and we have leasing professionals, about 13 of them throughout the country, that have multiple relationships, and we've recruited these folks to our firm because of the relationships and how well they know the tenants. Where Mike's team will bring us a deal, and they'll have us get in front of these retailers very early. So this is Tropicana Center. This is Las Vegas, Nevada, not far from the Strip. During due diligence of this shopping center, Sam's Club was up in 2022 as we were acquiring this asset. Prior to acquiring the asset, we had a fully negotiated 10-year renewal signed, wet ink on paper with Sam's Club. It was contingent upon us closing on the asset. So we got the deal done prior to closing. Once the deal closed, it became hard. And we were really able to mitigate our risk and execute upon our key piece of the business plan even before we own the asset. So that's a really big win, and that's something that we do constantly here at FNRP. We have relationships with majority of these retailers, and we're talking to them really early on in the process, even before we own the asset. Another one that I'm really proud of and the team was able to execute upon was this Randall's deal at Champions Village in Houston, Texas. Sorry, I don't know if you're seeing those pop-ups on my screen as I'm driving this. So Randall's is Albertsons Credit. So Randall's is a large subsidiary of Albertsons throughout Texas. They were out of term and out of options, and we found that out as we were doing our due diligence during this acquisition. What we did with Sam Collier and our account team, Sam was able to get to Albertsons very early on in the process, negotiate a 10-year extension, doubling their rent. So we were able to buy the deal on in-place rent, and then we were immediately able to double their rent. So really, really a sound investment for us here and really mitigating the risk. And that's how we really do use our tenant-centric approach here at FNRP 360 and our 360 model, being able to touch every aspect of the deal, soup to nuts very early on in the process, and how we're able to return the investment to the investors. So with that, I will throw it back to Mike to bring out our first multifamily deal, Champion Townhomes. Mike?
Thanks, Fred. Champion's Townhome in Davenport, Florida. So if we scroll to the next page, please, Fred. So here we have an overview of the asset, 132 units, 66 3-bedrooms, 62 bedrooms, 6 ones, 97.7% occupied. This location is 40 miles southwest of Orlando, just phenomenal population growth in this Central Florida submarket. If we go to the next page, please. See a nice picture of the clubhouse here, Class A property, off market directly from a developer, leased up during COVID-19 with below market rents. Really just a very unique acquisition opportunity. We go to the next page. And it's unique for a couple of reasons. It's one, it's a rare combination of acquiring at an above market cap rate that's based on below market rents. I think what even makes that better is it's a 2020 build, so it's very low, if any, really deferred maintenance and capital investments. So outsized growth, strong acquisition basis, and low CapEx profile is a recipe for success in any property investment, particularly in multifamily. So you see some of the highlights here. Mentioned some of the growth in Central Florida, over 13% annual population growth per the last census data. Brand new 2020 construction at 205,000 a unit, very attractive acquisition basis. Here, the business plan is really just to institute institutional property management, mark these rents to market that are pushing 10 to 15% below market, as I mentioned, with minimal capital investment. So given the very attractive going in basis, we're going to stabilize north of a 7% here from a return on cost standpoint. So feel really, really excited about this opportunity. It's a $27 million all-in purchase price. You see the targeted returns here. So if you're interested in this investment, would direct you to our website, and we have some information on the back end of this deck as well. But really excited about the first multifamily launch, in addition to what our grocery anchored retail pipeline looks like as well. And that concludes the prepared deck, call it.
Perfect. Well, gentlemen, thanks again for joining today. We had a couple of questions also. I got a couple questions in asking if we're going to be recording this or sharing the deck. We're not going to be sharing the deck, but you can head on over to that website, fnrpusa.com/deal/champ to take a look at the deal. And there's a contact form on there as well if you want to reach out to the FNRP team to see about the deck. We are recording this webinar, and we're going to be sharing this recording with everybody by tomorrow. So if you have questions for Fred or Mike, please do use the Q&A or the chat to submit those questions. We've got a few coming in already, and I'll start with Danny's question. Danny asks, what's the current cap rate you're looking to invest today into multifamily?
So the cap rate on the Davenport deal is mid fives. It's right at 5.5. I think again there the story is just the outsized growth with minimal capital investment. So that allows us to lock in an initial loan at a fixed rate, and then refinance as well going forward based on just marking these rents to market with minimal capital investment with institutional property management. So we're really excited about it. We feel pretty strongly 5.5 is well north of market on a cap rate basis, or below market on a value basis at 205,000 a unit. Very good.
How has that changed over time, and what do you expect to see going forward with cap rates?
Yeah, I mean, I think that's the $1 million question. I think you started the year, I think everybody thought the Fed was going to continue to raise rates throughout the year. Now I think there's a strong argument that they start coming down the back end of the year. But I think the good news is we feel really good about the asset level business plan at Davenport and elsewhere, and that as a leveraged investor, we're leveraging off a spread of in-place debt, and we're locking that debt and buying assets where we can grow cash flow. So that's a recipe for success, again, whether that be multi, industrial or retail. The fixed rate debt, being able to ride the inflationary environment on the rent growth with a specific business plan as well. So we feel really opportunistic about this environment and our ability to continue to source acquisitions.
We had a question about some of your national retail tenants. I don't know if this person may have missed your slide from earlier or wanted you to kind of expand on some other examples. I know you noted Whole Foods, Publix, Walmart, a handful of other national retail tenants. Can you tell us about some of the other national retail tenants that you have at your properties?
Sure. I think you mentioned the big ones. Kroger's our largest in terms of store count. Walmart's our largest in terms of GLA. We have a number of Safeways, which is a subsidiary of Albertsons. We have a number of Aldi anchored. Also have a number of apparel and discount users. We've got TJ Maxx's, Ross Dress for Less. Through that category, Burlington Coat Factory, Five Below, Dollar General, Dollar Tree, Family Dollar. It's a lot of the discount users that are really looking to expand throughout the necessity-based grocery anchored retail, as well as a lot of fitness users and a lot of boutique fitness users you see, as well as a lot of QSR and food. So we really run the full gamut. from the largest of the Walmarts of the world to the local nail salon. We have them all throughout our portfolio.
Very good. Had a question or two about your minimum investment. What's your minimum?
Yeah, typically we say our minimum investment is $50,000. So on average, that's what we're looking at as a minimum investment, first time investment.
Yeah, not too bad. Very doable. We work with a lot of other operators where their minimums are 100 or 250 or up. So 50's very reachable for a lot of high net worth investors. We here at Wealth Channel kind of got our start in the opportunity zone space. So a lot of our audience are familiar with opportunity zone investing. Not everybody, but we had a question here about opportunity zones specifically. If you intend to have any opportunity zone product at some point.
Not currently. Again, perhaps sometime in the future.
Very good. Question here from David. Another question from David. Does each property stand alone as an investment opportunity? Are your investors going into the deals directly, or do you bundle properties together and offer essentially like a multi-asset fund for diversity geographically?
Sure. So it is an individual investment. I think oftentimes we'll bring out. We just finished fundraising for a core Atlanta grocery anchored portfolio. It was a Publix and Kroger anchored centers so that's the structure of the investment. Is at a deal level, not across a fund structure.
A question here from Alan wants to know, what is the typical acreage size for a grocery-based retail project, and are there any improvements for EV parking at those sites?
Sure. I mean, typical acreage on a 150,000 foot grocery anchored center is probably plus or minus 15 acres is a decent rule of thumb. And I'll let Fred answer, but I know that monetizing our parking lots is certainly something that's top for us.
Yeah, we have a whole ancillary income program where we're constantly looking at ways to generate ancillary income at the property level and drive revenue at the property level. So we're working with multiple users that have EV and EV charging stations that are coming throughout our portfolio.
Good. Let's see. Answer those two questions here. We got one about the Kroger Albertsons merger. Does that proposed merger have any impact on your portfolio, either good or bad? And also, what's your take on the likelihood of that going through?
In terms of what it does, am I freezing? I think my camera froze for a moment. Can you hear me okay?
You look good now. Yeah. I
can hear you.
Yeah, we can hear you and see you fine.
Okay. In terms of the merger, look, I think it's two very strong, solvent, obviously companies, and Kroger is our largest tenant, and we have a great relationship with them. We get a lot of intel. We just bought a Safeway deal in Waldorf, Maryland. We own a Safeway deal in Brandywine, Maryland, not too far. So we don't feel that it's going to have any impact in our existing portfolio, and we feel that our existing portfolio is currently in a good position between those independent grocers, independent of one another. Obviously as they merge, and we're kind of looking at that all the time during our acquisitions. And we looked at a deal earlier last week in our investment committee that had a Randall's and a Kroger nearby, and that was the question that came up: would one impact the other? But we have very good relationships with both of the tenants. They're both very strong retailers and strong grocers, and we're excited to continue our growth with them. Mike, I don't know if you want to add any more color on that from your point of view.
No, I think Fred summed it up well. I think in our view, the right real estate wins the day, and it's certainly a consideration when we're looking at a new acquisition in terms of what the proximity is, what the spacing is from one flag to the other. And nobody knows. It's that would be difficult to hedge from a new investment standpoint. But at the end of the day, you have to believe in the real estate you're buying and the rent basis and co-tenancy, and it's all very, very situational.
Yeah, and couple off of that, we run grocery voids on every deal that we do. And we work with a grocery advisor that has a whole analytical platform that they work with us. So we're really getting in during due diligence and mitigating our risk and really understand if there are incursion risks within that specific market and what the risk is if we're going to potentially lose a grocer during our hold period, which is what we want to avoid. So we're doing as much work and we're spending a lot of time and money on the front end and during due diligence, really investigating these assets and investigating, the health of that grocer staying at that individual asset.
Good. Another question came in here. By the way, we got a lot of great questions coming in. Keep sending them in. Use that Q&A tool in your Zoom toolbar. I'm also monitoring the chat as well. Actually, the person who asked the question about the minimum investment is also asking if there's a locking period or a lockup period, I guess.
There are hold periods for every asset. So typically 3, 5, 7, and some 10-year holds. So it just varies by asset. So that would serve as the lockup period for the investment, whatever the given business plan is for the asset.
Good. Not atypical of what you might expect from a commercial real estate investment. Let's see. Next question coming in. Do you do everything in-house from start to finish? Regarding your 360 slide earlier, wondered if that means you control everything with your in-house team.
Yeah, from an operating standpoint, we operate the asset soup to nuts 360. It's part of our platform and part of what we do. And we made a decision early on in 2021 to bring everything in-house. Prior to that, we had some third-party vendors working on a few things, as well as third-party brokers handling the leasing of the assets. One of our core values is everything world-class and treated like we own it. So because of that, we brought everything in-house. So you have everything from property management to asset management, finance, acquisitions, accounting, leasing, all handling the asset 360 degrees.
Great. Ethan asks a question about how your deals are structured and how the returns kind of trickle down to the LPs. Specifically, he mentions that the gross deal IRRs that you cited and what's printed in your deck are extremely impressive. He assumes that that's at the deal level. How does it waterfall down to the LPs?
Yeah, it's a good question. It's very investment specific, and I would just encourage. I would direct people to our website and specific deals because it's each one structured a little bit differently, and wouldn't want to generalize nor go in the weeds here. But Champion Townhomes, as an example, we're doing with a multifamily partner, so that one looks a little different than maybe the Atlanta deal I referenced previously. But absolutely, those are gross returns. There is a net to the investor, and I would direct everybody to the website.
Very good. We talked about parking and EV charging revenue. Are there any other ancillary revenue sources beyond EV charging?
Sure. There's temporary leases that we'll do the temporary Spirit Halloween deals. I just put through a few of them this morning, as well as cell phone towers, billboards, designated parking spaces, pylon signs, where we'll get the tenants, if we have an open pylon, we'll get the tenants to offer what they'll pay for us for the pylon signage, and then we still retain rights to taking those back at any certain point if we bring in a national or something to that extent. So we try and keep our ancillary income fluid and try and maintain control of our common area throughout the asset, as well as our inline spaces, to make way for the longer term, more creditworthy deals when you look at those temporary spaces in line. So there are a number of ways to generate ancillary income, and we currently are building upon that as we mature.
Perfect. Another question coming in asks, can you tell us more about the deal that we're seeing on the screen right now, the Champion Townhomes? What's the asset management plan on that deal, and why did you choose that deal? I don't know if this person may have come in late. Maybe you can recap some of the points.
Sure. I'll try to be brief here, but could talk about this one for a while. I think again, this off-market opportunity. We have a distressed seller. the business plan here is fairly straightforward, but I think that the key is the ability to source this opportunity, acquire it off market, and on the acquisition. Again, we're buying an above market cap rate, below market price, and that multiple is on rents that are significantly below market. So the business plan here is institutional property management that's bringing rents to market through rent software technology, more closely tracking comps and leasing closer to market. Some operational inefficiencies related to some of the amenities that aren't fully utilized the way they should be. So it's again, above market cap rate, below market rents with a very low CapEx profile. This is a 2020 build. It's just a really unique opportunity in that way.
Very good. Hopefully that answers that question for that individual who wanted to learn more about that Champion Townhomes deal on the screen right now. Daryl asks, you indicated that you perform the construction under your organization. Do you hire outside contractors and construction managers to serve as your representative to oversee those contractors?
Yeah, we manage, we have a construction management department that will manage the project and sub out to specific contractors within that specific market.
Very good. Alan asks, does your company list acreage for sale, or is it necessary to obtain a broker for a grocery-based retail center?
I'm not sure I understand the question. We don't, the shopping centers we own, we typically like to own as much of it as possible and like to control the entire environment. I think, maybe potential out parcel spinoffs, but those would be, leased more triple net investments. I'm not positive I understand the question. Fred, did you catch that?
No, I understood the first part, which you already answered. We don't list any acreage for sale. And to Mike's point, we'll do long-term extensions on out parcels, and then we'll look to spin those off in the triple net market. Can you restate, Jimmy, the second part of the question?
Yeah, the second part of the question was, is it necessary to obtain a broker for a grocery-based retail center?
So I'm guessing what he's asking is from a third-party leasing standpoint, Mike, is how I interpreted the question.
Could be.
Yeah. So, and I touched on this a little bit earlier. We do all of our leasing in-house, right? So we have 13 to 15 leasing professionals throughout our leasing department that are out in the markets. We actually track and measure how often they travel to the properties so they can touch base with the tenants and be in the markets with the brokers that represent the tenants on a weekly basis. So they're constantly traveling. They all work remote. And they've been selected, like I said, because of their relationships with the tenants and their ability to perform. And we like to lease our own assets, and we do it in-house because we own the asset, and we don't want, sometimes when you have a third-party broker leasing an asset, for example, they could also be leasing your competitor's asset across the street. So they can be shopping the deals between the two assets and going where they can make their fee. We don't do that here. We only lease what we own. We don't lease anything outside of what we own.
Good answer there. Yeah. Daryl, if hopefully we answered your question. If you want to clarify, please feel free to do so. We'll see if we can get back to it. Let's see. Another question came in. This person says that they missed a few minutes. Apologize if you already answered this, but what is your approach to leverage? I'm sure it varies by deal, but is there a ballpark target leverage ratio? And my guess is with the Fed raising interest rates like they have over the last 12 months or so, maybe your strategy's changed on how you use leverage. Maybe you can answer that as that's my question as well. How has your approach to leverage maybe changed over the last 12-month period?
Sure. So, I think it's very situational to your point, Jimmy, and it varies by product type. I mean, grocery anchored retail is typically in the 50 to 65% range, with multifamily being 500 to 1,000 basis points higher, but very situational. I mean, the Davenport deal, again, we feel like the purchase price is below market and the NOI is below market, so we're more comfortable there at higher leverage. That one is 70%, and again, multifamily is typically higher leverage. So very situational, but generally for retail, it's 50 to 65, and and multifamily is going to be 5 to 10% higher than that, just depending on the business plan for the asset. As far as how our debt strategy has changed in the current environment, I think I think we continue to be steadfast in understanding what the right debt is for the business plan. I think that's the constant. I think part of being the most active grocery anchored acquirer last year is also we're the most active sponsor from a debt standpoint. So we get to see a broad swath of terms. And, we really want to pick the right debt that matches the business plan. And a lot of relationship lenders that we have in-house, certainly, some understand that better than others, but I think that continues the main focus. I think there's a lot of volatility in the debt markets, no question about it, but I think being a proven sponsor continues to be a tailwind for us.
Great. Lydia asked a question here about available vacant church properties. Have you considered purchasing any available vacant church properties? Ever worked with that property type?
We have not. Oh, go ahead, Mike.
Yeah, I was going to say we have not currently, but I think one of the nice things about our tenant-centric approach and what Fred and his team bring to the table is we're talking to our retail partners every day, and they have certain open to buys in certain markets, and we're actively pursuing that as an acquisition source in terms of the ability to buy land and maybe build the suit for a grocer, and so it's certainly an opportunity. It could be a church, could be something else, but nothing we specifically targeted as a business model.
Okay, next question. Go ahead, Fred.
I was just going to say, we do have an inline church in one of our assets in Hickory Hollow, Antioch, Tennessee. It's a Kroger anchored center. They are on the end cap, and it is one of our tenants. So everyday needs.
Very good. Next question coming in asks, can I invest my retirement money into your deals? IRA ? I guess this person wants to know if they can put your deals into an IRA.
Yes, you can, and we can help facilitate that with our in-house investor relations team. They'll put you in touch with an intermediary and help facilitate that process.
Very good. How about the banking crisis that has been in the news recently with what's happened with Silicon Valley Bank and Signature? Has that affected FNRP and its properties at all? And if so, do you see rates going down as a result potentially?
Yeah, I think we've certainly seen rates come in subsequent to that. I think unfortunately, as a borrower, we've seen kind of lender spreads blow out to make up for a lot of that. But it didn't have any impact on us operationally as a company. It's more the broader macro environment, and it certainly has kept call it spot rates lower, treasury rates lower, interest rates lower for a period of time. We'll see how sticky that is, but operationally no impact. It's just added fuel to the broader macro environment and just that volatility.
Very good. How often do you provide distributions to your investors? Let's see. The passive income angle is very interesting to me, this person says.
It's quarterly distributions on the assets.
Quarterly distributions. Very good. Let's see. Alan asks, Publix has a first floor product in a Charleston, South Carolina high-rise residential building, which seems rather atypical. Is that catching on around the country? Have you seen more conversions like that?
I think you'll see that in more of probably the urban core markets where you have first floor retail and then a garden style apartment above that. I don't know, Mike, if you want to touch on that a little bit, but I think it's more urban metro markets.
Yeah, agreed. I think a lot of municipalities are pushing for that. I think whether or not it's the demand is really there is another thing. And I agree with Fred. It's more the infill, the real estate you can densify and the higher FAR real estate is typically more infill. But absolutely, when that works, it works really well in terms of the live work play aspect.
Good. The new deal you were talking about looks pretty interesting. What's the rental market like in that area?
It's very strong. I mean, if you look at we have some comps in the deck online, and you look at the occupancies. I mean, just the benefit of that trade area in Central Florida. I mentioned the population growth. I mean, there's a lot of demand drivers for the multifamily space, specific to Central Florida, as well as some of the macro demand drivers I talked about with the affordability of homes and interest rates and inflation.
Good. Another question about the Davenport project that's up on the screen right now, kind of following up nicely with the previous question. What's the expected population growth in Davenport over the I guess short term, midterm, long term, however you want to take that?
Yeah, I think looking back, the last census data, it was 13.5% on an annual basis, so 13.5% every year for 10 years. And go forward, it's supposed to be pretty close to that, depending on whose projection you look at. So again, just a great market to get into, highly coveted market, especially from a multifamily standpoint.
Very good. Another question here comes from someone with some hands-on real estate management experience. This person asks, how do you handle property management nationwide? This person says, I can barely keep up with my handful of tenants.
Yeah, we handle property management in-house. We have in-house property managers placed throughout the country for our retail assets. So really everything is done in-house, and they have their vendors that they work with on site in individual markets, and we'll have porters there on site every day doing a little bit of third-party work, but it's all managed by our in-house property management team. In regards to the multifamily, we'll be getting, I believe, Mike, it's through the sponsor on the deal, and we'll be getting best in class property management through that sponsor, whether they do it in-house or they third party it. So retail, everything is in-house. And then in terms of multifamily, it's going to be best in class third party or with the sponsor.
Excellent. What about your exit strategy, or what happens at the end of the hold period? Do you 1031 these properties into another property, or do you return the capital back to your investors?
So investors will have the option to 1031 at the end of the investment. We certainly have the deal flow and track record and the ability to facilitate that for an investor. But certainly they're welcome to take their capital and reinvest it or redeploy it some other manner. But we'll absolutely offer that 1031 capability in-house. It's again a key differentiator for FNRP.
And the mechanism behind doing that, do you end up setting up a Delaware statutory trust for the investors, or is it a more direct, straight 1031 exchange?
It's more direct. You set up different TIC entities for each investor.
Got it. Let's see. A couple questions are a little bit repetitive here, just going through this list here. We talked about debt a little bit, leverage a little bit. What kind of debt do you use usually for, or do you usually source for your deals, is what this person asks.
Sure. Again, very situational depending on the business plan. I think, like Champions would be more of a bridge loan once we grow the NOI. So we wanted shorter term, a little more flexibility, always fixed debt, especially in this environment. That really fits the business plan for the asset because we have more heavy value add. I think some of these assets that have less of a business plan, less of a value add component, it's more stabilized. The Atlanta portfolio I mentioned, that was a life company loan. So very competitive. Life companies there's certainly a flight to quality there. This was a trophy portfolio, had a lot of life company interest. So, between life company and bridge, it pretty much runs the gambit and everything in between.
Good. We've got about 4 more minutes left here before the top of the hour. We're going to try to get everybody out of here before 2 p.m. Eastern time. I've got just a couple more questions for you gentlemen. Really appreciate you being here with me today, and appreciate everybody attending and all the great engagement. A lot of great, interesting questions. This is a question about inflation now. Inflation is, I guess it's ticking down a little bit. We're in an environment that's disinflationary, but the level of inflation is still really high. We experienced our highest levels of inflation of inflation in about 40 years recently. Can you discuss how commercial real estate can be a great hedge against inflation, and why do you feel that way?
Yeah, if you go back to, and it's a great question and one we get all the time from our investors. If you go back to the KPI slide, last year alone, we were at 7.69% on our prior rent from when that tenant renewed. So that's the ultimate hedge against inflation. We also have contractual increases throughout leases that helps hedge against inflation. So constantly, pushing against those spreads and really generating the return for the investment. Mike, I don't know if you want to touch on the multifamily piece with inflation.
Yeah, no, I think it's very similar. Continuing to push rents and inflation. One of if not the biggest cost for individuals is going to be their housing costs, and that continues to be a driver for rent. And it's not just the 7% that Fred alluded to. It's you're driving rent at 7%, but then you're getting a significant multiple in the way of cap rate on every dollar of driven rent. So every dollar of rent is between $14 and $20 of value. So certainly very mindful of that, and that's something that is again a key differentiator for real estate and multifamily. You can mark to market every day. Retail is a little less frequent than that, but we still had phenomenal success driving rent in this environment, and inflation being a tailwind to rent.
We got a question about the retail sector in general. In the era of internet shopping, and that internet shopping, I think, increased significantly during COVID. Are retail stores in trouble, or do you expect them to continue to thrive as an asset class?
We say the best retail continues to get better, and it does. And kind of why we focus on the grocery necessity piece in retail is because that portion of retail, is never going to go away. You can't get your haircut at home, paint your nails at home. If you want it done through that service, you're going to go to that retail center that has that offering and has those everyday service needs throughout the entirety of the asset. And what you'll see is, and I come from the mall world, the brands like Buckle, Foot Locker, Signet, which is K Jewelers, Zales Jewelers, what have you. Those brands are coming out of the malls and they're coming into the grocery anchored retail centers because they understand that it has more foot traffic and more everyday needs and repeat customers throughout the year or throughout the week. And as opposed to, the tertiary mall that you're visiting once a month, right? So they're coming where that foot traffic is. They're coming where those sales are, and they really are driving to the grocery anchored retail centers.
Great. We got a question here in the chat about Champion Townhomes. What's the occupancy rate there, or what are you expecting?
Occupancy rate there is 97, pushing 98%. So, I think we have opportunity to not only continue to drive rents, but I think we'll maintain or even grow that occupancy, believe it or not.
Excellent. I think we'll end on this final question here. This person asks, how is FNRP different from all of the other syndications out there? Why FNRP over anyone else?
It's because of our platform. It's the decision we made in late 2020, early 21 to bring everything in house. We inspect every aspect of the deal. We go out multiple times prior to signing a contract or acquiring a deal. Myself, Mike, the CEO of the company, Kurt Padavano, we're constantly on the road visiting these assets and making sure that we're securing the investment for our investors, because we don't want to put forth a bad product. We want to get the return to the investor, and we want to continue to do that in the future. So it's because of our FNRP 360 platform. It's because of our tenant-centric approach in working with tenants. We take a lot of pride in what we do, and we just want to be a good partner all around.
Perfect. Well, gentlemen, that's all the time we have for today. Thank you to our sponsor, First National Realty Partners, and to Mike and Fred for presenting today. And a special thank you to you, our audience, for watching today's presentation. Great engagement today. Loved all the questions. To watch more of our podcasts, webinars, and events, please subscribe to the Wealth Channel YouTube channel. Just head to wealthchannel.com/YouTube, and you'll also be the first to get notified of when the recording of this webinar is available. That's wealthchannel.com/YouTube. That concludes today's programming. Thank you, gentlemen, so much. Thank you, everybody, for attending. Really appreciate it.
Thanks, Jimmy. Appreciate the opportunity.
Thanks very much for having us.
Thank you.